Between June 1st and June 5th, 2026, Wall Street experienced a rapid and severe recalibration of risk. Looking at this chart comparing the Nasdaq and the VIX over that 5-day stretch, you can see the inverse relationship perfectly illustrated. The Nasdaq sheds almost 5%, while the VIX volatility index experiences an explosive upward spike, reaching the 21 level. A drop of this magnitude is not a standard technical correction. For months, institutional capital operated under the assumption of a Goldilocks economy: moderate growth, cooling inflation, and imminent rate cuts. That mathematical assumption is now dead. What we are witnessing is the abrupt repricing of broad market equities to account for sticky inflation paired with slowing economic momentum. Capital is being forced to aggressively adjust to the reality of stagflation. To understand why the Goldilocks narrative collapsed, we have to trace the catalyst back to physical supply chains. Over the weekend, geopolitical tensions translated into tangible disruptions in the Middle East. Iranian IRGC drone and missile strikes targeted critical infrastructure in the Gulf, including Kuwait's international airport and facilities in Bahrain. These strikes effectively stalled transit routes responsible for 20% of global oil and 30% of the world's fertilizer supply. That physical bottleneck immediately manifested in energy markets. Brent crude spiked to $92.87 a barrel, forcing supply-side inflation back into every downstream financial model. This vertical bar chart tracks the ISM Services Prices Paid Index, a leading indicator for corporate input costs. You can see it jumped straight to 71.3, hitting a massive 4-year high in a single month. When input costs leap this violently, the resulting inflation becomes structurally embedded in the economy. This dynamic ties the central bank's hands, entirely eliminating the possibility of a near-term monetary rescue. Any lingering hope for lower interest rates was then erased by the May employment data. The nonfarm payrolls report blew past Wall Street estimates, adding 172,000 new jobs. With the unemployment rate locked at a rigid 4.3%, the labor market remains far too hot to justify economic stimulus. In a late-cycle economy, robust employment data signals to the market that borrowing costs will not be coming down. Compounding this data is the approach of the new Federal Reserve regime. By officially adopting a policy of strategic ambiguity, the central bank has deliberately removed the safety net of forward guidance that equity markets have relied on for years. This animation illustrates the bond market's mathematical reaction. Stripped of forward guidance, bond traders demanded higher term premiums, sending the 10-year Treasury yield soaring to the 4.54% threshold. A risk-free rate sitting firmly above 4.5% acts as an immense gravitational pull on corporate valuations. It forces capital to abandon long-duration growth assets and retreat toward defensive, cash-generating safe havens. High borrowing costs are only half the equation. Surging yields have exposed a deeper structural flaw within the technology sector itself, an extreme fatigue over artificial intelligence capital expenditures. We are witnessing the formation of a massive liquidity black hole. The hardware required to train and run next-generation models is so expensive that the internal cash flows of tech giants are no longer sufficient to sustain the arms race. Alphabet shocked the market by announcing an $80 billion equity raise. That capital is earmarked specifically to fund massive data center and compute expansion, meaning the world's premier search monopoly must dilute its shares to keep pace. Simultaneously, SpaceX confirmed a $75 billion IPO at a historic $1.7 trillion valuation, preparing to absorb an immense amount of available institutional cash. Add to this the escalating rumors that Meta is exploring its own secondary market offerings to fund its AI rollout, and a clear pattern emerges. Institutional investors are doing the math. The realization that AI infrastructure is a bottomless cash catch, paired with the looming threat of massive equity dilution, is instantly sucking over $150 billion of liquidity directly out of the broader market. In a liquidity vacuum, even flawless corporate execution is severely punished. Companies trading at extreme multiples are expected to clear hidden, astronomical whisper numbers just to maintain their current stock price. Take Broadcom. They reported 143% growth in AI semiconductor revenue and generated over $10 billion in free cash flow, demonstrating incredible operating leverage. This chart highlights the current valuation paradox. Despite spectacular growth, Broadcom's equity value was slashed by nearly 20. Lululemon emerged this week as the ultimate canary in the coal mine, suffering a devastating double-digit flash crash. A close look at their balance sheet reveals gross margins cratering by 410 basis points. Surging input costs and a severe drop in physical foot traffic squeeze their profitability from both ends. High energy costs and sticky inflation are actively eroding middle-class discretionary income. This limits the upside for any retail equities, creating a dual-front crisis for investors navigating both tech hardware and consumer goods. Navigating a liquidity drain requires a clinical shift in perspective. You cannot change the macro environment, but you can systematically exploit the panic it generates. Top-tier portfolio managers rely on the fat years philosophy. They do not step in to catch falling lives during the initial shock. Instead, they wait patiently on the sidelines, holding cash until algorithmic liquidations severely misprice companies with undeniable economic monopolies. This indiscriminate sell-off has now created precise, deep value entry points. For assets possessing insurmountable compute moats, we are looking at highly actionable setups for the next 3 to 6 months. The first tactical setup is Alphabet. While retail investors panicked over their $80 billion raise, that capital is actively building an unassailable physical compute moat. Berkshire Hathaway's $10 billion injection at a discount firmly validates the structural advantage. This technical overlay maps the parameters. We are targeting an entry zone near $360. A strict stop-loss must be placed at $325 to manage downside risk, while the upside profit target is set at $420. Next is Broadcom. The stock is deeply oversold, yet their monopoly in ASIC chips remains intact, backed by a 67% operating margin. As the price yields to oversold conditions around $385, we identify our entry. The stop-loss anchors at $355, and we set our target at $450. Marvell Technology offers another compelling profile. The stock just survived a brutal 16% washout, shaking out weak hands. Their silicon photonics moat is now heavily secured by a $2 billion NVLink integration with NVIDIA. Shifting the parameters for Marvell, the entry aligns near $263.50. The stop loss is tight at $235, eyeing a recovery target of $320. Finally, Meta. Despite the anxiety surrounding potential secondary offerings, Meta's ad cash flow provides a bulletproof balance sheet to absorb AI expenditures. This final setup targets Meta at oversold levels between $590 and $593. We place the stop-loss below support at $550 with a target of $680. When broad market liquidity is draining, these 4 targets represent the only logical destinations for institutional capital. It is about leveraging extreme panic to secure long-term infrastructural dominance. Looking ahead, navigating the broader indices over the coming weeks requires strict attention to a few critical metrics. Monitor the VIX closely. If it holds its ground above the 20 level, it signals sustained institutional fear and ongoing options hedging, meaning the volatility is far from over. Watch the June 12th SpaceX IPO. A $75 billion liquidity drain will test the market's limits, potentially triggering further capital rotation out of secondary tech stocks to fund those allocations. As for the S&P 500, establish your baseline expectations around a consolidation zone between 7,250 and 7,450 while the market digests this new interest rate reality. For more deep dive U.S. stock and market analysis, remember to like, subscribe, and share Calling Monster Finance.